Welcome to the Secret Edge Stock Trading Podcast with host John Zachary. This video is about how to roll for credit until you win, including how to change, quote-unquote, flip the trade direction. When a credit spread fails, roll for credit until you win. We begin a bull put credit spread because prices are rising. So we sell puts and receive a big credit, and we buy a lower put and pay out a little bit of money. The green arrow up is where we get in the trade. On the 8th day, the prices collapse. The options expire on the 10th day, and we didn't get out in time. What shall I do? Number 1, review the long-term bullish trend and note that prices have been rising for months. We're in a short-term price pullback as shown in the upper right. Consider the choices. Number 1, take a small profit if you have it. Number 2, take a loss. Get out. Number 3, roll for credit until you win. Or number 4, flip the trade from being bullish to becoming bearish. If you have a small profit, then take it. Go to the next trade. If you must decide between a loss and rolling for credit, the market trend strongly points to rolling for credit. What if market direction is changing? You can decide to flip the trade from bullish to bearish. However, flipping against a strong uptrend would be a bad decision. We decide to roll for credit based on the strong uptrend. Go to the portfolio, select the credit spread to begin the rolling for credit transaction. In this example, the leg 1 and leg 2 make up the original credit spread. We will be closing leg 1 and leg 2. We will be opening leg 3 and leg 4. They will replace leg 1 and 2. To begin, there are 5 columns we can change for legs 3 and 4. The action of buying or selling to open. Column 2 is the quantity. Column 3 is the expiration date. Column 4 is the strike level. Column 5 is the option type. It's either a call or a put. Please understand that when you flip the trade from bullish to bearish, you will replace the bull puts with bear calls. So flipping the direction is done by liquidating the puts and setting up the next trade using call options. When you flip the trade, write everything down on paper. Then set up the trade. When this is done, the call strike levels will differ significantly from the put strike levels. Flipping from bullish to bearish or the inverse is just another roll for credit trade. You must change the option type and select very different strike levels. In this example, the leg 3 has been changed to a call option. In this example, leg 1 is buying to close the strike level 66 put that expires on March 20, 2026. Leg 3 is replacing leg 1 by selling to open the strike level 65 put. In this example, leg 3 is 1 strike level below leg 1. We are closing strike level 66 and selling strike level 65 that expires on March 27. In this example, Leg 2 is selling to close the strike level 64 put that expires on March 20, 2026. Leg 4 is replacing Leg 2 by buying to open the strike level 63 put expiring on March 27. However, there is a problem as we cannot obtain a credit. Accepting this change requires us to pay a 15-cent fee. We must find a way to get a credit. The midpoint is a debit of 1 cent between the bid and the ask. Is that acceptable? Possible solution: change the fill price to a credit level and hope it will be filled. However, unlikely to get filled, but it might if you're lucky. Consider a more likely solution. Change the expiration date to a week later, April 2 in this case, to get more credit. Also, you can change the strike levels from a range of 2 strike levels to 5 strike levels. In this example, changing the expiration dates and the strike levels will let us obtain a credit of about 90 cents, meaning $90 more credit. Is this acceptable? Problems could arise from these 2 changes. Number 1, it takes 2 weeks instead of 1 week to expiration. A lot can happen in 2 weeks instead of 1 week. You're doubling your risk as far as time goes. Number 2, you need $410 because the strike level difference is now $5 instead of $2. Please keep at least 25% of your funds in cash to facilitate trade problems when trading options. Which trade gives us lower risk? Roll the options for a debit of only a penny. Why? Number 1, expiration is only in 1 week, lower risk. You don't need additional funds to trade it, less money at risk. Number 3, the debit of a penny has minimal impact since we already received a credit. The midpoint with a debit of 1 cent between the bid and the ask gives us lower risk. Take the trade even with a bit more debit if you can make profits with the risk minimized. However, do not take the trade when you will not be profitable. If you cannot get an acceptable credit, then exit with a loss. Or you may be in a trade where you must flip the direction to win. That means changing from bullish to bearish or bearish to bullish. Consider a trade example that can only win by flipping from bullish to bearish. This will illustrate how to flip bull puts to bear calls. The trade appeared to be acceptable about mid-February. However, on March 2nd, the Iran war hit the stock market. This is only to demonstrate a bullish to bearish trade. Close legs 1 and 2, and we're going to open legs 3 and 4. We're going to replace the options expiring on March 27 with options that expire on April 17. We're going to replace the puts with call options. The strike levels were set up out of the money for each trade. Since a loss was unavoidable, more than one trade will be required to become a winning trade. Keep setting up bear call spreads on one side of the market until the rolling for credit becomes a winning trade. Please paper trade to prove you know what you are doing. It's easy to make human errors. Practice and keep your head in the game. So 3 things are important: the watch list, the daily post, and the ROI calculator. Looking forward to helping you make money. Have a great day from the SecretEdge.us website.